Hey everyone, and welcome back to the channel. I've got to tell you, something truly surprising is happening with the Russian economy right now. For years, we've heard how sweeping Western sanctions and international isolation were supposed to cripple it, yet it largely defied many early predictions of collapse. But now, top officials inside Russia itself are issuing stark warnings about an economic downturn. It appears the country is staring down the barrel of a formal recession, a significant shift that could send ripples across global markets, potentially affecting everything from energy prices to broader geopolitical stability. Just recently, Russia's economic development minister, Maxim Reshetnikov, delivered a surprisingly transparent assessment. He plainly stated that the economy is on the brink of transitioning into recession, emphasizing that while official figures are often like a rear-view mirror reflecting past performance, current business sentiment strongly points to an imminent contraction. He highlighted a dramatic slowdown in economic activity. After a robust 4.5% expansion in the final 3 months of 2024, their GDP, or gross domestic product, saw its year-over-year growth plummet to a mere 1.4% in the first quarter of 2025. This marks their slowest quarterly pace in 2 years, and on a quarter-over-quarter basis, their economy is already showing signs of shrinking. Business confidence has fallen to its lowest point since late 2022, signaling a broad downturn, particularly impacting sectors beyond their vast military-industrial complex. For instance, civilian goods production has consistently dropped by 0.8% each month, raising significant alarms. Of course, not everyone within the Russian government shares this pessimistic outlook. Their finance minister, Anton Siluanov, maintained a more optimistic stance, describing the economy's state as simply cooling, and confidently asserting that summer always follows cooling, implying a natural and temporary dip before recovery. Similarly, the central bank governor, Elvira Nabiullina, framed the situation as the economy recovering from overheating. She explained that their recent economic growth was characterized by demand outpacing supply, which was the root cause of their persistent inflationary pressures. Even some prominent bankers, such as VTB's CEO Andrei Kostin, while acknowledging the cooling trend with metaphors like icing and freezing, stated he sees no signs of such a dramatic economic downturn. VTB analysts still project a modest 1.5% growth for the Russian economy in 2025. And even Reshetnikov's own ministry, surprisingly, forecasts an even more optimistic 2.5% GDP growth for the year. However, the CEO of Sberbank, Russia's largest bank, German Gref, offered a far more troubling diagnosis. He characterized the current economic situation as a perfect storm, a confluence of multiple unfavorable factors working against sustained economic growth. He specifically warned that declining profitability for many companies, driven by stubbornly high inflation and elevated real interest rates, that's the central bank's 20% key rate minus an annual inflation rate of just under 10%, is severely impacting cash flow and forcing businesses to postpone crucial investment decisions. This he views as a significant threat to economic expansion, not only this year, but potentially for the next 2 to 3 years, hindering long-term productivity and national competitiveness. The central bank's benchmark interest rate is a central point of this economic debate. It currently stands at a striking 20%, only recently reduced from an even higher 21% set in October 2024, which marked its highest level since early 2000s. Gref and other influential officials are vocally pressuring the central bank for much deeper cuts. They argue that rates in the range of 12 to 14% are necessary to incentivize companies to invest, boost their cash flow, and restart broader economic activity. Yet, the central bank, through its Monetary Policy Department Director Andrei Gangin, maintains that the current high rates are critical for attracting investor flows into ruble assets, which helps strengthen the currency and, crucially, slows inflation. They assert that low inflation ultimately benefits both citizens and businesses, even while acknowledging that a weaker ruble would assist exporters, particularly during global economic downturns. Another critical component of Gref's perfect storm is the ruble's unexpected strength. While Russia's currency has demonstrated paradoxical results, strengthening by 38% against the dollar from January through April 2025, and even being recognized by Bloomberg as the year's best-performing currency, Gref argues this is severely counterproductive for the economy. He contends that an equilibrium rate, one that would stabilize the economic situation and be beneficial for their export sector, should be significantly weaker, closer to 100 rubles per US dollar, rather than its recent rate of around 78 to 79 rubles. An overvalued ruble negatively impacts Russian exporters' revenues and directly contributes to a growing government budget deficit, which is already projected to hit around $5.6 billion this year, more than triple its initially planned figure and the highest since the COVID-19 pandemic. This deficit is partly fueled by Ural's crude oil trading below government expectations. For over 2 years, Russia's economy has shown surprising resilience to Western sanctions. This was largely attributed to massive defense spending, which propelled growth and kept unemployment rates low. Recruitment bonuses for military enlistees and death benefits for fallen soldiers injected substantial income into the country's poorer regions, stimulating domestic demand. However, the central bank governor, Nabiullina, has now openly admitted that the underlying economic resources that fueled this war-driven growth, including available labor, industrial capacity, and liquid assets from the National Wealth Fund, are almost entirely exhausted. Specifically, the fund's currency reserves have plummeted threefold since the start of the war to roughly $35 billion, reaching their lowest level since the fund's creation in 2008. Corporate profits in March fell by a third overall and by half in the oil and gas sector, indicating widespread financial strain. While Western leaders implemented the G7 plus oil price cap to limit Russian oil revenues, it has largely failed, with major buyers like China and India reportedly ignoring or evading it, allowing Russian oil export volumes to remain above pre-war levels. Despite efforts to mitigate revenue, Russia's oil and gas revenues have still fallen by 10% year on year, accelerating the country's budget deficit. Interestingly, the recent escalation of the Israel-Iran conflict has caused oil prices to spike, offering Russia a potential, though temporary, lifeline for its budget if sustained. This complex economic landscape underscores an internal struggle within the Kremlin, balancing the financial demands of the ongoing war with the urgent need for broader macroeconomic stability. President Vladimir Putin himself has unequivocally declared that a recession must not be allowed to happen under any circumstances, directly instructing his government and central bankers on this priority. He has repeatedly called for a shift towards balanced growth and has denied that the economy is solely propelled by the defense industry, also highlighting contributions from the financial and IT sectors. Historically, Putin has demonstrated a strong inclination towards fiscal stability, preferring careful budgetary control. Nevertheless, the current economic trajectory, marked by slowing growth and rising deficits, suggests he faces a difficult choice between sustaining military outlays and addressing the mounting economic pressures felt by businesses and ordinary citizens. This inherent conflict means that while macroeconomic stability remains a top concern alongside the war, Russian businesses and workers are likely to bear the brunt of any necessary adjustments. The coming months will be absolutely critical for Russia's economic future. The trajectory of their economy hinges entirely on the policy decisions made by its government and central bank. Whether they can navigate this complex and precarious landscape, avoid a formal recession, and ultimately find a sustainable path forward, especially with resources reportedly depleted and internal pressures mounting, remains a huge and uncertain question for the world to watch. Thank you for tuning in today. I hope this gave you a clearer, more nuanced picture of the significant economic challenges currently brewing inside Russia. If you found this breakdown useful, please hit that like button, share this video with anyone who might benefit, and consider subscribing to the channel for more timely and insightful analyses of global economic developments. We'll continue to track this unfolding story and keep you updated as new information emerges. Until next time, take care.